We're going to be looking at the recapitalization drive taking place in the continent. Joining me virtually to have this conversation is Adegboyega Adebajo, who is an economist and lead advisor at Amethyst and Ashler Advisory. Good morning.
Good morning, Chairman. How are you?
I'm fine, thank you. How do you do?
Very well, thank you. It's a good Monday here in Lagos. I hope it's the same in Abuja.
Oh, sure. It's a good Monday here in Abuja. Now, before we delve into the conversation, we saw that just last week here, the NESG and the World Bank put out some numbers, the economic outlook that they have for us as a country. And what's your take on that?
Well, it's okay having projections, and I think it works well to always have a goal to work towards. Realism, that's always a question we want to ask ourselves. As a target, it's okay, and it's pleasant. It's a good thing to see the drive towards that. But at the end of the day, what actually informed that figure? Because it's not pulled out of the air, and the big question is it something we can really achieve, and at what cost is it going to be to Nigeria? We've seen what we've called stability in the economy, and I hear these days is that we've achieved stability. Now we have to consolidate this stability, and so that's what's led to the projections we have.
All right, now let's look at the World Bank particularly just briefly. It says 4.4% in 2026 and 2027, and according to them, the fastest pace in more than a decade. And they are likening this to happen mostly due to some of the things that took place last year, some of the sectors we saw that did well, which is services, agriculture, and non-oil sector. Do we expect to see these things actually continue to take place in 2026 and help to put these numbers, make it a reality?
Okay, so services is growing amazingly fast. Again, it's a low capital entry sector in most cases. And so you find that drive there. But for me, the perspective is that what's actually driving the optimism here are the tax reforms. And the idea here is that if indeed the government widens the tax nets, and we have a situation where tax collections increase, tax to GDP ratio, as you know, is an index that's measured to look at efficiency, then we may have a situation where the government is actually able to fund its budget, even if it means borrowing, to the extent that the fiscal policy and the monetary policies align, and we can then see government spending going into productive sectors. When that happens, services is ready to take its place. It's leading right now. Agriculture has suffered because of the insecurities in the north. We're looking at 2026, and the belief is that that would improve significantly. If that does, there should be a significant rise in agricultural output. So those two sectors mainly, and of course, they're part of the non-oil sector in the economy.
All right. Okay, thank you so much for your insights on that. Now, let's get to our conversation today, the recapitalization drive taking place across different sectors. Now, for our viewers out there, recapitalization refers to raising the minimum capital base for companies operating in regulated sectors. This is part of the broader drive to strengthen financial stability, improve service delivery, attract quality investments, and reduce systemic risk. Now, in 2025, 2026, and 2027, some are going to go into that year. But Nigeria has seen major recapitalization moves across multiple sectors led by regulators and policy makers. Now, pension industry, will start off with the banking. I'm going to start off with the banking industry, where we will see quite a few things taking place there. Now, why we're starting with the banking industry is because their timeline and compliance ends March 31st, 2026. Now, banks are expected, for different types of banks, to have certain increments take place. Now, they say for banks with international licenses
Operations,
or
yeah.
operations, 500 billion naira is now the capital base. Now, the last time this was done, it was done in 2008, if I recall correctly, under the current Emir of Kano, Emir Sanusi Lamido, the 16th, and it was 25 billion naira at that time. Now, this is close to about 200% increment or so, or that, for that to happen. Now, that's what's happening. Now, for banks with regional, just national operating, you're not beyond the Nigerian sphere, it is 200 billion. And for banks with just regional operating licenses, it's 50 billion naira. Now, that's for the banking sector. We go over to the pension sector, where PFAs are now, minimum capital requirement has been raised from 5 billion to 20 billion. That's 400%. Pension fund custodians now base has been increased to 25 billion now. Deadline to meet is the 31st of December 2026. However, I believe it's kind of been expanded to 2027. Now, for the small PFAs, they may have to pursue mergers or they may have to exit the scene. Now, it doesn't stop there. We go to the insurance sector, where they have to have those increments as well. Now, I'm going to ask you, what's your take on this recapitalization drive? As the first thing we said, he said it's a good thing. It's supposed to help financial stability. But do you think that these will actually help in these sectors in the long run?
Okay, Chamaka, first of all, I'm going to start by being very basic. When we talk about recapitalization, what exactly are we talking about? And let's just cast our minds to any business at all. It doesn't have to be a bank. All businesses ought to have some degree of equity. The shareholders put a stake in the business. They put their capital at risk to do the business. It's their own money, the owners of the business. And over time, the more stable the business will be reflected in the size of the capital. The capital allows any business to absorb shocks. So if there is a loss, because there's significant capital, existing in the business, the loss can be absorbed, and maybe the business will then grow again or recover or move on. And over time, depending on the volume of business being conducted, there may be a need to increase the capital or the equity in a business. And that means that that business has a lot more money. Sometimes this is done by asking external shareholders to come in, or other investors to come in, and then the number of shareholders increase, the amount of money to do business increases. And so the volume of business can actually grow. Then again, if a business is going to borrow, lenders will typically look at the capital of the business in terms of saying, how strong is your business? And, can you take on this loan and back it up with assets? Assets in the form of your own equity. So that's the basic thought behind it. Now, when we look at regulated sectors, and particularly not just banks, but the financial sector, all businesses, bank and non-bank businesses in the financial sector, are operating within the sphere of money, one way or the other, or financial capital, liabilities, as it were. The key reason they're all regulated is because the government has an obligation to the citizenry to ensure that none of these institutions suffer the sort of failure that would lead to the loss of their monies because they're doing businesses with these organizations. So one thing the regulator tends to look at often enough is the level of capitalization of these institutions. We may be talking about banks right now, and that's where we are. But let's bear in mind that it's not just about Nigeria and the central bank. There is the International Bank for Settlements in Basel in Switzerland, and they have prescribed what should be, based on stress tests because they're keeping an eye on the global economy, and they have prescribed certain levels of capitalization. And when you think about the fact, like you said, it was when Emir Sanusi was governor of the central bank that we last had a recapitalization, or as we tend to say in the industry, a regulatory driven recapitalization. So it happened then. But when you look at the dollar value of the naira that was in the capital basis, and you look at the 400%, 500% increases you're talking today, those percentages practically reflect the devaluation the naira suffered in 2023. And so that tells you that the capacity of institutions in that sector to be able to take on risk, especially international risk, becomes very, very limited. A lot of their clients, businesses they're dealing with, need a lot more money. So take, for instance, a businessman who's probably, let's just say someone not too sophisticated, who's probably trading with China before the devaluation in 2023, used to do business worth about 50 million naira in China. Now, when you think of what 50 million naira could get in dollars in 2023, and you think of what 50 million naira can get in dollars now, you will understand that, the bank's capital had shrunk compared to the size of their customers' businesses. So it makes absolute sense to drive this up. And once you're driving banking, it trickles down to all the other non-bank institutions, financial institutions, insurance, stockbrokers, pension funds. Everyone needs to step up to be able to ascertain that there's stability in the sector. And you won't have an instance where one institution fails and then there's a domino effect in other sectors or subsectors. So that's where we are, Chiamaka.
You put out an opinion that you don't think these industries, banking or some of these industries, require this recapitalization. Or you still do you still have that belief?
Yes, so that comes to roles persons play. In the financial sector, you've got individuals who are represented as firms. Because, for instance, you would need to be regulated and to register to be recognized, for instance, as a capital market operator or a financial advisor to certain institutions. What you are doing is providing intellectual capital or inputs into a process. In some cases, you're merely intermediating, you're getting investors and you're linking them up with people who need capital. And in between that, you advise in terms of what instruments would allow the money to flow. And that transaction itself is monitored and registered by the regulators. And so the key thing here is, if you are intermediating or if you hold an advisory role, is there any need to then ask such a firm to essentially increase its capital to say 1 billion or 2 billion? I don't need I don't need 2 million naira in capital to provide advisory, okay, to a $500 million transaction, because it's all intellectual. And I'll give you an example. In any transaction like this, outside financial advisors or intermediaries, you've got other professionals. In some cases, if it involves real estate, you're going to have a surveyor. You will definitely have solicitors on both sides of the transaction. You will definitely have accountants on both sides of the transaction. And even in cases where we do capital raising in the energy sector, oil and gas, you have an expert person's report. These professions do not need this level of capitalization. Again, they're professionals. What they bring to these transactions or to the deal flow is the intellectual representation, which their professions, which they represent through their professions, and that adds value to the transactions. So it's almost like saying, oh, if you're a law firm or you're an auditing firm, you had better increase your capital to 1 billion or blah blah blah. It's totally unnecessary in my view, and I think it's important for the regulators to look particularly at the role that certain institutions will play and enable more persons who may not need or be able to capitalize to be able to play that intellectual role in those transactions.
Okay, so now one of the things that come out or happen, fallouts or, response to recapitalizations, we see mergers and acquisitions or fold-ups in some cases or downsizing in some cases. Now, from these sectors that these recapitalization drive is taking place, the banking sector, the pension sector, the insurance sector, which of these sectors are we most likely to see a lot of consolidation and probably downsizing take place?
Well, in each and every one of those sectors, Jamaica, you're certainly going to have combinations coming into play. There's just so much money available for investments in the financial sector. Let's just understand that in terms of the economy, the financial sector is simply there, and it probably isn't the one that provides the highest return to investors, perhaps compared to energy, amongst other things. So you have a situation where money is always looking for where it's going to get the highest return. So if I'm a portfolio manager or I'm an individual investor with a portfolio and some funds, I may say I want to take a stake in the financial sector, but I'm not going to put my entire investable funds in that sector. So there will be a limit. And at some point in time, some firms or businesses may not be able to achieve the target recapitalization, and they're going to end up having to work on combinations to be able to continue to do business, or to be absorbed totally by a larger company. We've seen this happen before, not just today. Back then, in my investment banking days, I certainly did handle a couple of mergers involving insurance companies. Of course, we also did banks, and so it's certainly going to happen again. Clearly, the indications are already there, and I'm aware that certain banking institutions are talking to one another. I believe certain insurance companies are starting to look around in terms of who possible partners may be for a merger. So yes, we will see those combinations come into play.
All right, let's take a look at some of the things we have on our screen right now, showing us the different sectors and the things that are incomes and that are supposed to come to take place with them and their timeline. If we could have that on the screen shortly, we could see the banking sector was starting off there on that list, and we're going over to the pensions. Then we're moving over to insurance and the security. So there with banking, as I said earlier, commercial banks, 500 billion, national license, 200 billion, regional 50 billion. And the 2-year window, they started theirs in March 2024. And by 31st of March 2026, we're going to see what's happening. As he said, now there might be some mergers, some acquisitions, some consolidation, some downsizing. In pensions, we're seeing what's happening. It's been extended 2026. However, for the fund custodians, is now being extended to 2027, June 30th, while insurance companies, starting as life insurance, is now 10 billion naira and it's now July 30, 2026. Still in insurance, we're seeing some things happening there as well. Non-life insurance companies, 15 billion, till 30th July. So for insurance, basically, is the 30th of July 2026. That is the compliance deadline. And, reinsurance companies, these are companies that actually insure insurance companies, that they have to have 35 billion naira, and composite insurance companies 25 billion naira. Now, recently, just a few days ago, last week here, Securities Exchange Commission came up with their own recapitalization, and that is what we're seeing now. They're starting with brokers, 600 million. Proprietary dealers, 1 billion. I believe this is what you were kind of referring to earlier, Mr. Adebajo, when you were saying you do not see why people in advisory roles have to have a capital requirement.
Yes, that's right. Although brokers do carry certain liabilities because they hold accounts, okay, they hold trading accounts. They have there's something like bank deposits,
Okay.
so each customer to a broker has. So there's certain liabilities, and I can understand stockbrokers who are traders needing to increase their capital bases because they also trade on their own accounts.
Okay.
And if they suffer losses on those accounts, which are theirs, the business makes a loss. So it's important that they have a significant capital base to be able to absorb that loss, so they don't go out of business and then all their customers lose their funds. So yes, there are brokers. And that's why I simply said, it's important to understand the roles. But an advisor who does not take on company accounts, does not take on any liabilities, and somebody who plays an intermediation role, essentially an issuing house does advisory work. One starts to think, and perhaps for issuing houses, since most issuing houses these days are actually licensed commercial banks, they already have to meet the central bank's capitalization targets.
Okay.
So yeah, that just solves all that.
All right. Now, one of the key things that we look at is, access to credit. Now, with this recapitalization drive, especially for the financing sectors, is this in any way going to help access to credit to SMEs and households?
So, Chemeka, that's the other part of the whole concept of recapitalization. I'm so glad you just asked that. So again, I'll go back to the basics. So I'm a business. I'm just doing business, and I recapitalize. So I raise money. Let's say I have 3 friends and they tell me, oh, they like what I'm doing. I'm 100 million, and they'd like to put 50 million each into the business. And that's another 150 million. So I dilute my shareholdings and I have 150 million naira new business, and I'm a trader. What does that do? Am I going to put all that money into trading? No. At that volume of business, I need to start looking back at my structures, my systems, my employees, staff training, the environment through which I operate. So usually when an institution decides on its own that it needs to recapitalize and it starts to look for funds for growth, it will have marked out certain things it will apply the money for. Right now, where recapitalization is regulatory driven, and I must say this because I was in banking at that time, you will find the same instance happening again. Banks, for instance, will wish to create liabilities as much as they can. And creating these liabilities is actually limited right now because from a monetary policy perspective, the tight monetary policy is still there. It still exists. The cash reserve ratio is high. The interest rates are there to discourage lending too much. And so when this money is obtained, I expect that most of it will go into expansion of infrastructure for these institutions, perhaps increase in technology, upgrading and updating the technology they have. And that's very key because technology moves in quantum leaps. But beyond that, I start to wonder where the money will be deployed. One thing that we were doing then was to also look for what was referred to as big ticket transactions. So you want to look at the large corporates, and you're going to talk to the largest organizations and say, hey, I've got this amount of money and I can fund your growth, blah, blah. And when that starts to happen, because of the tight monetary policy and the high exchange rates, not so much of that money is going to go into the SME sector. Not so much of it, because that's also a high risk sector. And remember, the indices, when you are analyzing banks in particular, is you're going to be looking at their bad loans, as against performing loans. And so they're going to try to make sure that a larger percentage of the new money raised goes into performing loans so they can earn some income and increase their profits. Because again, it's equity, they're going to need to pay dividends on that equity. And therefore, it means profit must also rise significantly. So it may seem like a good thing to an organization to say, hey, I've got this amount of capital, but it's also a headache in its own terms, because it's capital that must be employed and that must generate a return for the owners of the capital.
Oh, another fallout that will take place, or that takes place when recapitalization happens, is the issue of employment. What do we expect to see, when this happens? Are we going to have another wave of people losing jobs, mass retrenchments after this deadline, especially with the banking sector coming up March 31st, 2026?
Well, I wouldn't quite make it sound as disastrous as that, Chamaka.
Okay.
Certainly, when there are combinations, some desks will disappear. Some jobs are going to have to go. You can have one bank taking over another bank, and they've got two branches right next to each other on the same streets. One's going to have to go. And again, with technology anyway, the use of physical human resource is actually reducing. The idea is to deploy technology as such. And this is a challenge that for those who are employed in the banking system, they need to understand in terms of how much upskilling, training, and their enablement in terms of using technology they have. That's going to determine those who the bank will feel will provide value. And I say the bank, but essentially I mean any institution at all that has had to recapitalize or that may have to merge. Recapitalizations themselves don't lead to merging desks, but where you have business combinations, those are mergers and acquisitions. You would inevitably have a situation like that. So employees must make sure that they continue to be those who add value to the organization.
Oh, well, look, there's that too. Hopefully, things can be done. Now, away from the employees working, let's look at the broader people, the people that these services serve, the customers. How will they perceive this recapitalization, where they don't feel, where they feel protected? What can be done by the regulators and the companies themselves to make their customers, consumers feel protected, and that this is not some elitist agenda?
Well, so for the customers, I have no doubt that a good number of customers will have taken the opportunity to buy shares in those banks where they can. What you find is that depending on the size of the bank and the customers they have, the amount of capital they may be able to raise from their customers is fairly limited. I wouldn't want to put forward a guesstimate here, but certainly a lot more of greater percentage of the amount of capital raised in a public offering will come from existing customers one way. It would seem like a sort of saving. I'm using this service, I might as well earn something from them just as they're taking money from me. So you find that happening. It's also a form of savings. So yes, the customers will not feel it's elitist at all in any way. However, and I'm not sure if this is what you imply, will those customers then benefit from the services after the recapitalization to the extent that they will earn dividends if a profit is made? So and let me bring this down to an individual level, perhaps. So I invest 5 million naira in a bank's recapitalization, and I cannot get a loan from that bank because the interest rates are high, and I don't think that will work for my business. But the bank then goes ahead and does some kind of 500 million naira transaction with a large company, and it earns some profit on it. At the end of the day, some of that profit is going to come to me in the form of a dividend. So have I lost at the end of the day? Perhaps not. I would have to look for other means to fund my business. But then here's a message which I have put across to some SMEs at certain forums where I've had cause to engage with them directly. For banks, they will need to use the money. That capital cannot sit in bank treasuries. Otherwise, if it does, you're going to find the federal government issuing bonds. You're going to find treasury bills, and that money is going to be absorbed and held by the government. So if you are an SME, I think it's important to start thinking and engaging your bank in how you can access some financing at this time. Again, banks will innovate. The old vanilla products they have, which is straight lending, may not quite suffice anymore. So they'll be thinking in terms of new products through which they can deploy the capital they have for the benefits of their customers. Banks are that creative and that innovative. So I expect that to happen too. So yes, the customers will benefit at the end of the day.
Okay. Now, in 1 minute, just tell us what does success look like a few years down the line after this recapitalization drive?
Well, I'd love to see an economy that's pretty close, if not almost close, if not almost there, actually, to the government's targeted 1 trillion naira economy. This recapitalization in itself ought to create a multiplier. The financial sector is the best sector through which an economy can actually provide that multiplier into the system. It will be deployed as credits as much as possible, depending on the monetary policy there is. And even if it's deployed as credits and businesses grow, through the fiscal policy, the government itself would also be able to generate revenue to be able to undertake its spending program. So the expectations are we ought to see a growing economy. We ought to see an economy in which businesses themselves, I mean, if we say the economy has grown, then we need to be able to see that in the volume of transactions that businesses are doing. We ought to be able to see that in the amount of disposable income that Nigerians have. And it should all reflect. And maybe, just maybe, success would look like having or sitting in or living in a 1 trillion naira economy.
Mr. Adebajo, for your insights on the recapitalization drive taking place in Nigeria.
Thank you very much, Maka. It's wonderful.
And that's our program this morning. And in case you just joining us, we've been talking about the recapitalization drive taking place across different sectors of the economy, starting from the banking sector, whose compliance deadline ends March 31st, 2026. Of course, going over to the pensions, which some of them will over to 2027, and insurance, 2026, 2027, and of course, Securities Exchange Commission comes with their own last week, extending to 2027 as well. These recapitalization drive, hoping that it would actually help firm up the economy, firm up the businesses, and equally keep your confidence in investing in the Nigerian economy. I am Chiamaka Wafo. Same time, same place tomorrow. Bye for now.